Hi, everybody, and welcome to our May 2026 Rosedale Family Office Market Outlook. My name is Ian Love, and today we'll be talking about geopolitical risk amidst market resilience. It's been a very, very interesting year, but first, before we get to my colleagues who are joining us, we want to say a big Rosedale Family Office welcome to Kavi Tana. Kavi has recently joined us in the past few weeks working with Allison on our wealth planning team. So if you start to see Kavi in a few of your meetings or a few emails, please reach out and say welcome to him. He is new and joining the team. We're very excited to have him join us from AGF. So if you see him, please extend a nice thank you. As the title of today's webcast alludes to, it's been a very, very interesting year. There have been some very, very scary geopolitical and news headlines that have been out there, and the impact that that has had on clients' emotional psyche when it's come to investing is one of the most interesting things that we've seen throughout the year. Everybody has a very negative perception of what is happening within the markets, at least from when we talk to them. And that has not necessarily been the case in terms of market performance on a year-to-date basis. And what Himalaya and Noah are going to be talking about within this webcast is really how and why that is the case. Because if you had talked to us about, a war in Iran or the Middle East disrupting energy in this way, the odds are you would have thought there would have been a larger impact. But when we look back at history, there's actually some opportunities that can be had as we look through this conflict. So I'm going to turn the call over to Himalaya and Noah. We're going to walk through how we're viewing the markets, how we have seen things been impacted, and where we are now today versus where we were at the beginning of the year. And if you have any questions, comments, concerns, or anything like that that you want them to address live right here on the webcast, we are going to do a Q&A at the end. Himalaya, you've been the steady presence in the portfolio throughout all of this. Actually, we had a client call you the greatest of all time, or GOAT, the other day in a communication due to your level-headedness throughout these conflicts and throughout these turbulent markets. So Himalaya, why don't you give us an update and take it away from here?
Ian. I think you gave us a really great intro to the conversation. So we're just going to dive right into some of the questions that I've got for Himalaya today. But as Ian said, if anything comes to mind for you during this conversation, put it in the chat or text it to your Rosedale Family Office advisor, and we'll make sure to have Himalaya answer it on air, and we can see if anybody can stump him today. As always, there is a prize if you can stump Himalaya. HJ, let's start where Ian kind of left off for us, which is on the oil market. So some predictions have it that about 20% of global oil supply has been affected by the conflict in Iran and the broader Middle East, specifically around the blockage of the Strait of Hormuz. And many would have predicted that that would have had a much bigger impact on energy prices globally, but it hasn't yet. So how are we thinking about that, and why has it had this more muted reaction?
Yeah, thanks, Noah, and thanks, Ian. When we think about the oil market, it's tempting to simplify things, and 20% of global supply sounds like a very large number. We have to remember, though, that it's not as simple as just one statistic. If it was indeed 20%, we would be experiencing a lot more economic fallout than what is currently being experienced. So let's break it down a little bit. So the world consumes roughly 100 million barrels a day of oil. So 20% of that flow coming out of the Persian Gulf, that's 20 million barrels. So the reason why we haven't seen the catastrophic implications are a couple-fold. One is about half of the flow that normally comes out of the Persian Gulf has actually been diverted through pipelines. And so Saudi Arabia's got a big pipeline, and they've been now shipping, instead of through the Persian Gulf, they're actually shipping to the Red Sea and putting it onto tankers and shipping it out to Japan and China and Korea. So Saudi Arabia, believe it or not, is actually shipping just as much as they were pre-Iran war. The other factor to consider is just inventories. Every major economy in the world typically holds inventories of crude oil. And that number is actually quite staggering. It's 8 billion barrels of oil. So when you think about the 10 million shortfall per day that's not getting exported, and you think about the global inventory, just that simple math tells me that, we've got 800 days potentially of supply before we really start to run into some supply issues. Now, again, it's never as easy as that. The reality is that some countries have got massive inventories, and then you've got other countries that have got no inventories. And that's why you are experiencing, or why you're seeing countries experience various levels of pain here. So you've got some developing countries without inventories having to ration oil, have to tell people to work from home, to basically cancel flights. So that impact is actually not uniform. And when we think about the areas that we invest in, when we think about the US, Canada, both of these economies are net exporters of oil. And that's why that feeling that, that we're going to run out is simply not there.
Thanks, Emily. Yeah, that makes a lot of sense. And as always, things are much more complicated than a single statistic might have you think. So as we think about the energy markets in particular and how they might unfold over the long term, how concerned should people be if the conflict in the Middle East continues to drag out? You mentioned that there's potentially in some places several years worth of reserves. So as this keeps going on into the future, what's our level of concern and how should we be adjusting it as time goes by?
Yeah, that's the Pandora's box. Oil is something that we can't live without, and that shortfall in supply will eventually result in higher gasoline prices. We're already starting to see that at the retail level. So there will be some inflationary pressures. That's one clear implication of this. The other is, in a market driven by supply and demand, there is this thing called demand destruction, where either some countries will have to adjust to just consuming less, or they'll switch to other potential sources of energy over time. That's not going to happen overnight, Noah, but if this thing drags on for a very long time, there will be some switching that will happen, and we'll find a new normal. That 10 million barrel a day shortfall will be partly narrowed through the combination of just some demand destruction and maybe some greater production out of other regions, potentially Canada, the US, and other regions in the world have the ability to, over time, just increase production.
Okay. Yeah, that makes sense. So to broaden the discussion a little bit, with what's been going on in oil markets, one of the biggest questions I get is, or maybe it's not even a question, more of a reaction from clients, is surprise that the stock market isn't more affected by the price of oil and what's going on in the Middle East. And when we dig a little bit under the hood and look at one of our favorite statistics, which is consumer confidence in the US, it's actually, and you can fact check me on this, but it's at a multi-decade low. I believe it's actually lower than it was during the great financial crisis in 2008. So can you help square that circle for people? Why is the stock market not trading in tandem with consumer confidence and some of these big risk factors like the energy market?
Yeah, and I will fact check you, and you are accurate on that statistic. And what Noah's referring to is the most followed sentiment indicator of consumer confidence. It's done by the University of Michigan. They've been doing it for decades, and it is at a multi-decade low, lower than the great financial crisis, lower than the pandemic low. And yeah, it seems inconsistent for that to be at an all-time low, and yet the stock market's at an all-time high. So there are legitimate reasons, and we'll try to unpack that here over the next couple of minutes. So, you always have to question, is it that the stock market is overly exuberant, or is it that the consumer confidence is artificially low? And it's probably a little bit of both, but we think it's more to do with consumer confidence, for a number of reasons. When we unpack the just the political dynamic involved with consumer confidence, it's very clear to see that because of the polarization between Democrats and Republicans, that plays a huge role in how they're feeling and how they respond to these surveys. So when you look at Republican responses, their consumer confidence is actually fairly high and fairly unchanged over the last 12 months. Whereas you see Democrats have really dropped off. So that's what's bringing the statistics down. The other reason why consumer confidence has been falling more recently is, there is a kind of a knee-jerk reaction, a little bit of muscle memory when we think about high oil prices. So, for those that are old enough to remember what happened in the 70s, or even if you're younger and you've heard your parents or your grandparents talk about the 70s and how oil prices shot up and there were lineups at gas stations. So there is this muscle memory of high oil prices means bad. And so that's, that combined with the political situation and the polarization, those are combining to result in poor consumer confidence. Now, to explain why on the other side the stock market is doing well, there's no one single answer. There's a number of positive developments that have been happening. But before I get into those, again, going back to the 70s, and this is how it relates to oil, here's some interesting statistics. So back in 1980, kind of at the tail end of the oil crisis, the US economy was a lot more reliant on oil, not just imported oil, but just when you thought about consumption, how much the US economy was spending on oil versus GDP, that number was close to 10%. Today, that number is about 2%. The US economy in 1980 was a more manufacturing economy. Today, it's more of a service-based economy. So the economy has grown tenfold, from about $3 trillion in 1980 to about it's actually over $30 trillion. Yet the consumption of oil has only gone from 17 million barrels a day to about 21 million barrels a day. So think of that, that the US economy, and you could extrapolate this to many other economies. Oil is important, but it plays a lesser and lesser role in overall economic activity than it used to in the past. So that just reduces that sensitivity. That's very important to remember.
Himalaya, I might just jump in there with a question, actually. Could this also be a little bit of a factor of the makeup of the indexes as they've tracked the underlying US economy and moved more from industrial companies and retail companies and hard goods companies towards software and technology companies? Those large software and tech companies are much less reliant on the price of oil and energy prices in general. Is that also part of why markets have stayed so resilient?
Yeah, that's absolutely it, Noah. So when you think about the composition of the economy evolving over the last 40, 50 years, that same evolution is evident in the makeup of the stock market. So when you think about the S&P 500, that's the index that we talk about most. That is very much a services-based index, again, reflecting the underlying economy. So what that means is heavy weightings towards technology and financial services, rather than manufacturing and retailing, industrial companies, as was in the past. So you're absolutely right. The composition has changed to be less sensitive to oil prices as well. The most important reason why the stock market is doing really well right now, it's as simple as earnings, which is the fundamental building block of stock prices is how well are earnings doing? Are they growing? Are they flat? Are they declining? And this quarter, Q1 earnings season, again for the S&P 500, we're just at the tail end of it, and it is the strongest we have seen in about 5 years, where earnings on a year-over-year basis are growing at about 25%. And again, that number normally is more in the low double-digit range, 10 to 12. So for it to be coming in at such a high level, that is what has surprised everybody. And that's why you're seeing this recent strength over the past few months.
Himalaya, what's our explanation for that earnings strength? It seems like that might even be a little bit at odds with the consumer confidence numbers and price of energy potentially impacting companies' margins. So how are we explaining that really strong earnings performance from these companies amidst what might seem like a weak economic backdrop?
Yeah, that's a good question, and I think with some distance between now and when, being able to look back at it and dissect it, we'll know more accurately. But at the surface, what we're seeing is margin expansion. So gross margins have been expanding. Anecdotally, what we're seeing that companies do is either hold their staffing levels or maybe even rationalize them a little bit, while at the same time still experience top line growth. So we're seeing expansion in margin, which is leading to much faster profit growth than what was anticipated.
I'm sure the question that'll be on everybody's minds as they hear you say that is they'll think, is that AI and companies rolling out AI, meaning they don't need to be so reliant on workers? Do we have a definitive answer to that, or is it just too early to say?
I don't think it's too early to say. I think the impact of AI is starting to penetrate into the corporate world, and just anecdotally, when we're listening to company managements and how they're using AI, adoption is there, and adoption is increasing. So what's hard to say is how much of that margin expansion is because of AI, but there is definitely adoption happening, and we're seeing the result of it in the form of higher margins. But I think it's a combination of a lot of things: top line growth, some AI-led efficiencies. That's what's contributing to it.
Thank you. So that's the US story. And often in the investment industry, we can be guilty of being very US focused because it's the largest market in the world. And their media environment takes up so much of the space in our news feeds and TV channels. So we're very focused on what goes on in the US. But as Canadians, the economic backdrop seems at least very different than what's going on in the US. And we've had quite a bit of political upheaval and change in Canada because of some of the economic attacks that we've experienced from the US, namely tariffs and anxiety as we approach the upcoming CUSMA negotiation in a few months. So what's the economic story look like in Canada, and how has that impacted our markets here?
Yeah, that's a great question, Noah. So when we think about Canada, we're seeing it in the statistics where the economic growth it's lackluster. I think that would be a good way to term it. Not great, but also not recessionary. We're not seeing any forecasts of recession for the next several quarters. The Canadian economy, I'd say, is in a state of transition. It's been an economy that has been reliant on things like immigration, on housing development, and with those two kind of stuck in neutral, I think Canada's finding its feet as far as what will be the next driver of economic activity. So, the current government is out there promoting infrastructure projects, which of course will result in lots of jobs, some utilization of resources and manufacturing capacity. So that is, I think, what everybody is looking at. I don't think we've seen any shovels in the ground per se, but that transition is what Canada is experiencing right now.
And how do we view that transition and some of the new policies that the new Carney government has been enacting? That there's been a lot of movement and action from the federal government over the last several months. Some trade deals announced, new projects and spending, as you indicated. How are we viewing some of those changes, or do we think it's going to have a positive impact on the Canadian economy in the medium to long term?
Yeah, I don't think governments ever move as fast as we would like them to. Um, I think the I think the intentions seem to be heading in the right direction. Um, you know, Carney seems to be doing a lot of the right things, making new trade deals, trying to diversify Canada away from the US. Really laying the groundwork for these infrastructure projects. Unfortunately, there's lots of stakeholders, and it's not as easy to just say, we're going to build a new railway line or a new pipeline. You do have to go through the process, even though that process, they're trying to shrink it, but nevertheless, we have to get as many stakeholders on side as possible. But the current situation that we're in, call it a crisis if you want, that is actually helping bring a lot of the stakeholders to the same side. And I'm optimistic that, a year out, 2 years out, the Canadian economy is in a much better situation than it is. And, I love statistics. I'll throw one out at you. When you think about how much firepower the Canadian government has, and what I'm referring to is just how much debt they have relative to GDP, we've got one of the best balance sheets in the world. So the best of the G7. And even beyond that, when you look at OECD countries, which are about 35 countries, we've got, I think, one of the top 3 balance sheets there in terms of the level of debt. So we have the ability to dip into Treasury and spend, so long as it's spent wisely, to lay the groundwork for future wealth.
And with the upcoming CUSMA negotiation, which for those that don't know is the free trade agreement with Canada and the US, and Mexico as well, but it looks like it's going to be mostly a negotiation between Canada and the US. With that upcoming in a few months and lots of headlines about how that potential negotiation could unfold, how seriously are we taking that, and how closely are we watching it for what we own in our portfolios?
Yeah, that's a good multi-part question. So I think that is the biggest short-term risk here. The Trump administration is highly unpredictable, as everybody knows. Their objectives seem to change minute by minute. I think there are a lot of back channel discussions already happening, and they have been happening for quite some time. So I don't think it's a matter of, okay, the meeting's going to start in 2 weeks and then we'll see where it goes. I think there's a lot of again, discussions and narrowing of where the disagreements are. And probably it's been boiled down to maybe 3 or 4 key industries that where there might be quite a bit of disagreement on. But again, it's a short-term risk. I think both sides have kind of already started to lower expectations of a deal imminently, and it's something that could drag on well into the back half of the year, if not even into next year.
Okay, well, stay tuned. Our next webinar might be all about CUSMA, depending on how that unfolds. So that'll be an exciting one. You can come and ask Himalaya some questions about that. One of the challenges that we face, even though we do this professionally, but I know a lot of our clients face, is how to assess what's happening in the economy and their portfolios in the face of the constant barrage of news and political things happening and everything else in their news feeds and TV channels. So maybe you can just tell us how you're handling that, how you separate noise in the media from what we should actually be paying attention to, and how we advise our clients to what their relationship should be to political news and everything else versus their portfolios.
Yeah, it certainly has been a stressful time, whether you do this professionally or unprofessionally. Um, it comes back to those two key emotions that drive investing decisions: fear and greed. And we've seen headlines, constantly over the last 15 months that would get, investors to swing from fear to greed, lately mostly towards the fear side. What it eventually comes down to for us is it's about valuation. And it sounds boring, but it's what keeps us disciplined as much as possible to avoid making mistakes. So when I talk about valuation, it means when markets are expensive, we don't want to make the mistake of being too exuberant at that time. And vice versa, when valuation starts to look attractive, we don't want to be panicking and selling at that time. And instead we want to ideally be doing the opposite. So that focus on valuation and just arming ourselves with as much data as possible. That example about oil and how we're not about to run out of oil and it's not such a catastrophe. That is an example of using a lot of data to inform us that the earnings situation isn't likely to be impacted negatively in the short term just because oil has shot up here. So again, it comes back to the fundamentals. Ideally, we want to be staying focused on earnings and shifting our asset allocation based on that.
Thanks, Himalaya. I think that's a really good segue into my last question for you in the main portion of our webinar today. And then we'll move to audience questions. So get those questions in. If Himalaya mentions something that you want him to talk about a little bit further, you can put your questions in the chat. But my last question for you, Himalaya, is really around how you ended your comments there. For me, at least in my career, this feels like a time of most flux and change in the world and economy. And we've been through some very volatile times over my career with COVID and the interest rate change. But I don't know, this time just feels a little bit different. So how do we translate everything that's going on into the world into actionable portfolio decisions? And what have those actionable portfolio decisions been at Rosedale Family Office for our clients?
Yeah. As far as the first part of your question, yeah, I would agree. It does feel like we are being bombarded with more headlines that are driving those emotions again. The way I like to handle it is actually to just not watch the news at all. I don't watch any type of news. I'm just addicted to my Bloomberg, which is 99% business and economic news. And it's because the news does trigger those emotions, mostly on the fear side. But as far as investing goes, we have investing is all about learning. And I've been doing this for a long time, and there's never a day that goes by that I don't learn something new, and that means a better way of doing things. So what we've been doing, more recently is, we've realized that stock picking is, both rewarding, but it also comes with a lot of risk. You could have a theme right, but you could have the wrong horse. So we've moved gradually away from having too many individual stocks in the portfolio, and we've moved more towards thematic ETFs or actively managed funds that are able to either they've got better insights into a particular sector like technology, or we're just buying a whole basket of stocks within an industry because we believe in the theme. One would be the electrification of the global power supply, which is there's more demand than there is supply. A lot of investments going into it. So there's a lot of companies, not just in Canada or the US, internationally, that help build that out. So we just own a whole basket of that. So it's been an evolution, and again, we just try to stay as much focused on the fundamentals as possible, and that's our way of navigating this volatile period.
Thanks, Himalaya. Yeah, for today, we're not going to talk about any particular holdings or any particular portfolios, but I do encourage you to reach out to your Rosedale Family Office advisor if you want to know more about how some of Himalaya's comments previously has impacted your portfolio. But they've been very positive changes across the board. So as Himalaya said, we're always evolving, but we're very happy with the current state of the portfolios and how that evolution recently has resulted in very strong portfolios this year. We're going to switch to the audience questions at this point. I've got a couple that I'm sure you could have written down yourself, Himalaya, and anticipated coming. But the first and one that I get very frequently, even outside of this webinar, has to do with Canadian and more specifically GTA real estate and what's been going on in that market, from condos to detached housing to commercial and even rental rates. We do seem to be in a bit of a real estate. I'm not sure if you could even call it a recession at this point. I haven't seen the latest data, but prices on detached homes are down pretty significantly, and the condo market seems to have slowed down very much as well. So what are we seeing in the real estate market, and what should our clients be looking out for?
Yeah, that's something that inside the office or outside the office, that is something that I know I get asked quite a bit. Look, real estate is just like the stock market, very dependent on supply and demand, and it is a cyclical sector whereby you can't get supply built immediately, nor can you get demand changing immediately. And what happens is you have these lag effects. And what we are living through right now is the lag effect of too much supply that was started, 4, 5, 6 years ago. At that time, coming out of the pandemic, remember, interest rates dropped to close to zero and real estate prices started to take off. A lot of new supply was built. There was some speculation on the investment side, and that inventory, especially on the condo side, is being delivered right now. And it will take time to absorb, and it will get absorbed, just as it has in previous cycles. What's encouraging that I'm seeing right now, in fact, I just saw another article today of a private equity fund raising capital to come and buy up to 1,000 condo units directly from developers. So this is unsold inventory. So this is the third investment fund that I've heard of. And what that tells me is that supply demand imbalance, by the end of the year, we could get into a situation where a lot of the excess supply gets absorbed and developers start to think about restarting their manufacturing engine, because they know that even if they open a sales office today, that inventory is not going to hit for probably 5 years. So we will get out of this. It's just a matter of time, and I think we've been through the worst of it.
Thanks, Himalaya. Got a bit of a spicy one here for you. We'll see where you take it. For about 18 months, a couple of years ago, I think I couldn't go 24 hours without hearing the word Bitcoin or crypto. And that seems to have really fallen off the map lately in favor of some of the more or the newer trends, AI and data centers and some of those things. Is the crypto market something that we're watching at this point or paying attention to? And are there any opportunities there now that it's fallen out of favor with the broader market?
Good question. You know, I think the crypto believers are still believers. And I think in principle, the ideas of blockchain uh, make a lot of sense, and there is adoption happening, even in the financial services industry, as we expected that eventually crypto would get legitimized once the financial services industry started to embrace it. But a few things have happened that may have taken the wind out of the sails of the actual on the price side of crypto, which is these thing called stable coins, the ability to basically come up with a digital form of currency, whether it's a bank doing it or a government doing it, that and the ability to move money, across the world through stable coins, it takes some of the use out of crypto that people had thought about. So I just like with any new development, whether it's technology or innovation, I think crypto went through its initial euphoria. I think it's growing up. It's trying to find its use cases, and once it does, it will probably start to move again. But for now, it's something that we're not particularly investing in, but indirectly, whether it's through some of our financial services companies that we are invested in, or some of the active managers that we have invested in, we do have some indirect exposure.
Well, I, for one, am glad that I've stopped hearing about crypto every day. I think it's better for everybody's mental health that way. Last question from the audience, H. Shay. Big one, something that we've talked about a lot in the past because they've been very volatile over the last few years, is interest rates. It had seemed in Canada and the US like interest rates had come down to a more manageable level and would be pretty steady for a while. But with some of the recent inflation data and especially the oil markets and impacts that they're having on inflation, is interest rates something that we're concerned about? And if we have a prediction on where interest rates are going to go, what would that be?
Yeah, we haven't talked about interest rates in a while, and I remember again in the last few years, every economic data point, used to be dissected because we wanted to see if it would, lead to potentially interest rate cuts. I'd say, that word transitory, if you remember, it was used by the Federal Reserve and Jay Powell specifically, and they used it to say that, well, this inflation of 2021 is going to be transitory. Ultimately, it just lasted a little bit longer than expected. But I think what we're experiencing right now with higher oil prices, for the time being, I think it's being interpreted, or it should be interpreted, as transitory, which means that it shouldn't have any implications on interest rates. But again, coming back to one of your earlier questions, if we are in worst case scenario, if the supply disruption continues or gets even worse, what would be the impact? It could lead to inflation, and under those circumstances, we could see central banks try to rein in inflation. But again, I think what we've learned is when you have a supply-driven problem, you can't really solve that with interest rates. Interest rates typically influence demand side of the equation. You raise interest rates, it reduces demand. You reduce interest rates and it increases demand. It doesn't do anything to the supply side of the equation. So long story short, I don't think interest rates are going anywhere for the foreseeable future. There is a new Fed chairman starting tomorrow, I think. who's got a mandate from the White House to cut interest rates. But even so, I doubt there's any room, at least in the next 6 months, to cut interest rates very much.
Great. Thank you for that. And thank you so much to our audience for questions. Himalaya, it's always a pleasure to be able to have these conversations with you and share some of your wisdom and insights with our audience. So thank you very much again for taking the time. And with that, we're going to bring Ian Love back in to send us home.
Thanks, Noah and Himalaya, for your very insightful comments and Q&A back and forth. If we didn't get to any of your questions, or this has sparked a further question that you have later on, please let us know, and we're happy to get that addressed. Himalaya, I think one of the most interesting things when we think about headlines and kind of getting focused on sort of the day-to-day and the here and now is I think a lot of people get taken away from the longer term view. And you think back even so the past 8 years, what we've managed investments through, whether that's through Russia invading Ukraine, the inflation crisis, obviously, that we were just talking about, 2021, 2022, looking at COVID and how markets have responded to those crises, and how you and the team here have really kept a steady hand on the portfolio and allowed portfolios to grow and allowed our clients to accomplish the goals financially that they had set out. So I think a lot of people should take some comfort in the experience that this team brings. I don't think anybody's going back to the 1970s, Himalaya. Like, the oil crisis was not part of my family dialogue as a child, admittedly. But there's lots of long-term perspective here on the team when we think about investment portfolios. We're not just investing for tomorrow. We are investing for the next 5, 10, 15 years, because that's how long these portfolios and your money should last. So thank you both for some amazing comments and a great dialogue. Just to wrap up here today, I think there's a lot of anxiety. I think both Himalaya and Noah touched on it quite a bit. If you are having any anxiety, or you're thinking about things up at night, you're having intrusive thoughts about the markets. It happens all the time. Am I going to hit retirement? Am I positioned correctly in my portfolio? Please reach out to us. We don't want anybody staying up at night and contemplating the worst with their portfolios. I think a lot of people would be pleasantly surprised, to be honest with you, when they open up their statements, that the job that Himalaya and this team have done. So please, if you are feeling nervous or feeling anxious, or somebody that is feeling anxious and would like some reassurance, or would like somebody to talk to about their investments, please reach out to us and we're happy to chat with you. Thanks very much to everybody for joining us today here on May the 14th, 2026 for our Rosedale Family Office Market Outlook. Spring is somewhere on the way, I think. Hopefully we get some nicer weather. We look forward to chatting with you over the next few weeks before the summer hits, and we wish you nothing but the best. Thanks very much.